Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In yesterday's lesson we talked about the martingale and anti-martingale methodologies, the two categories which position sizing strategies can fall into. In today's lesson I'm going to talk about one of the more basic anti-martingale position sizing strategies, the percent risk model. So let's get started.
Okay, so the first step in determining your position size using the percent risk model is to determine how much you're going to risk on each trade in terms of the percentage of your trading capital. As we've discussed in our previous lessons on setting stops, studies have proven that over the long term, traders who risk more than 2% of their capital in any one trade normally are not successful. Another factor to consider here when setting this percentage is the win rate, or how many winning trades your system is expected to have versus the number of losing trades, as well as a few other components which we're going to discuss in future lessons. Once this loss percentage has been determined, setting your stop then becomes a function of knowing how large a position can be traded while still being below your maximum risk level. So let's take a look at an example here. Let's say that you have $100,000 in trading capital, and you've determined from analyzing your strategy that 2% or $2,000 of your trading capital is an appropriate amount to risk per trade. When analyzing the crude oil futures market, you spot an opportunity to sell crude at $90 a barrel, at which point you feel there's a good chance it's going to trade down to at least $88 a barrel, and you've spotted strong resistance just below 91 and feel like 91 is a good level to place your stop, okay? Which also gives you, as a side note, a reward to risk ratio of 2 to 1, which is fairly decent, okay? So now, the next thing you need to know is how much a 1-point move in that crude oil contract is worth, so you can then go about determining how much that move from 90 to 91, which is your stop loss level, is going to cost you in terms of a dollar amount. So basically, we're going to go into where you can find information on these types of things, but let's just assume you knew already that a 1 point or 1 cent move in the crude oil contract is equal to $10. Okay, so this gives you from that $90 entry price to that 91 stop loss level, that's 100 points or 100 cents, which gives you 100 times 10 risk per contract equals $1,000. Okay, now once you have that information, it's pretty easy to determine the contract size. The formula basically goes like this. The number of contracts equals the dollar risk per trade divided by the risk per contract, which we have from the last slide. The number of contracts is going to equal 2,000, which is our risk, the amount we're willing to risk per trade, divided by that $1,000 number that we got on the last slide from our entry price to our stop loss level, was $1,000 on one contract. Okay, and the result there is going to be 2 contracts. Okay, so for this example, we can trade a maximum of 2 contracts, or we would trade 2 contracts using the percent risk model on this trade. Okay, as pointed out in Dr. Van K. Tharp's book Trade Your Way to Financial Freedom, the advantages to this style of position sizing are that it allows both large and small accounts to grow steadily, and it equalizes performance by actual risk. Okay, the disadvantages on the flip side of that are it will reject some trades because they're too risky, which the fixed trade size per fixed amount of capital, which we looked at in 2 lessons ago, will never reject a trade. This will, because sometimes you're not going to have enough money in your account to justify the contract size that would need it to be traded and still be within your desired risk level. And there's no way to know what the actual risk is because of slippage. So going back to our example where we looked at entering the market at 90 and then having our stop at 91, For the calculation here, we assume that 91 would be our exit price, and you're not always going to get that 91 price. The market may run through that. You may get out at 91.10 or whatever it may be, and this is especially important, or it can affect performance pretty dramatically, especially when you're looking at placing tight stops or placing stops on large positions. Okay. So that's our lesson for today, and tomorrow's lesson we're going to look at another position sizing model which takes volatility into account, and it's called the percent volatility method. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below, and good luck with your trading.